Ever heard of a story where a bunch of internet memes and regular folks took on the giants of Wall Street? Well, buckle up, because the GameStop saga is exactly that, and it's wilder than any movie plot. Let's start with a little thing called short selling. Imagine you see a friend with a really cool, limited edition balloon. You think, I bet that balloon is going to deflate soon. So you borrow it from your friend, promising to give it back later. You immediately sell that balloon to someone else for, let's say, $100. A few days later, just as you predicted, the balloon starts to lose air and is now only worth $10. You buy it back for $10, return the deflated balloon to your friend, and you've just made a $90 profit. That, in a nutshell, is short selling. So Wall Street hedge funds do this with stocks they believe are overvalued and will drop in price. They borrow shares, sell them high, wait for the price to fall, buy them back cheap, and profit from the difference.
Wow.
Enter GameStop. In late 2020, GameStop was a struggling brick-and-mortar video game retailer. Think of it as that balloon everyone expected to deflate. Many big hedge funds like Melvin Capital saw this and decided to short the stock heavily. They were betting billions that GameStop's share price would plummet. It seemed like a safe bet. The company was losing money, and digital game downloads were taking over. From a business perspective, the outlook was grim. But then, something unexpected happened. A community on Reddit called r Wall Street Bets noticed just how heavily GameStop was being shorted. This wasn't just a few people betting against the company. It was a massive, coordinated effort by institutional investors. To the Redditors on this forum, known for their higher-risk YOLO trades and a love for financial memes, this looked like Wall Street kicking a company while it was down. They saw an opportunity, not just to make money, but to send a message. What if they thought, instead of letting the stock price fall, they made it go up? If the price rose instead of fell, all those hedge funds that shorted the stock would be in big trouble. Remember our balloon analogy? If the balloon's price went up to $200 instead of down to $10, you'd have to buy it back for $200 to return it, losing $100 in the process. This is called a short squeeze, and that's exactly what the Wall Street Bets community set out to do. It started as a trickle. A few users began posting detailed analyses, or due diligence as they call it, arguing that GameStop was actually undervalued and that the massive short interest made it a perfect candidate for a squeeze. One user in particular, Keith Gill, also known as DPEF ***ing value on Reddit and Roaring Kitty on YouTube, had been bullish on GameStop for months, long before it became a viral sensation. He posted videos and updates of his position, showing his initial $53,000 investment growing into millions. His conviction inspired others. The idea caught fire. It became more than just a trade. It became a movement, a crusade. It was David versus Goliath, the little guy versus the Wall Street titans. Memes flooded the internet. Apes together strong, diamond hands, meaning to hold on to your stocks, no matter how volatile they get, tanned rockets to the moon. People weren't just buying a stock. They were joining a cause. They piled into GameStop shares using commission-free trading apps like Robinhood. Many were first-time investors, drawn in by the excitement and the feeling of being part of something huge. They were fueled by a mix of nostalgia for the GameStop brand, anger at the 2008 financial crisis, and a desire to beat the suits at their own game. And the result was absolutely insane. In early January 2021, GameStop stock, ticker symbol GME, was trading at around $17 per share. By the end of the month, it skyrocketed to an intraday high of over $480. That's a climb of more than 2,700% in just a few weeks. The market was in a frenzy. Volume of trading was unprecedented. The hedge funds that had shorted the stock were hemorrhaging money. They were forced to buy back shares at astronomically high prices to cover their positions, which only pushed the price even higher, creating a feedback loop of epic proportions. Melvin Capital, one of the main targets, lost over 50% of its value in January alone and needed a multi-billion-dollar bailout from other funds to stay afloat. The balloon hadn't just stayed inflated, it had turned into a hot air zeppelin. But what goes up must come down. The ride was never going to last forever. On January 28th, at the peak of the frenzy, several retail brokerage platforms, most famously Robinhood, restricted the buying of GameStop and other so-called meme stocks. You could sell, but you couldn't buy. This move sparked outrage. Users felt the game was rigged. They argued that when retail investors were winning, the institutions changed the rules. The platforms cited market volatility and clearinghouse capital requirements. But the public saw it as a betrayal, a way to protect the hedge funds at the expense of the small investor. The buying pressure vanished, and the stock price crashed. In just a couple of days, it plummeted from its highs back down to below $100 and eventually even lower. Many who had bought in at the peak lost enormous amounts of money. The rocket had seemingly run out of fuel and came crashing back to Earth. The headlines turned from stories of triumph to tales of devastating losses. So what's the legacy of this whole saga? What did we learn? First, it exposed the incredible power of a decentralized online community. The internet has democratized information and communication, and now it was democratizing market-moving power. A swarm of individuals coordinated through memes and Reddit threads could collectively challenge the most powerful financial institutions in the world. This wasn't a centrally planned attack. It was a spontaneous, emergent phenomenon. Second, it pulled back the curtain on the complex and often opaque mechanics of the stock market. Terms like short selling, short squeeze, and payment for order flow suddenly became part of everyday conversation. People who had never thought about investing were suddenly debating the ethics of market structure and financial regulation. The subsequent congressional hearings put CEOs of hedge funds and trading platforms in the hot seat, forced to explain their actions to the public. Third, it highlighted a deep-seated generational and cultural divide. For many younger investors, this was a protest against a system they feel is rigged against them. It was a rejection of the traditional financial establishment that they blamed for economic inequality and crises. The language they used, "Dape's diamond hands." Attendees was a cultural identifier, setting them apart from the old guard of Wall Street. The GameStop saga was more than just a financial event. It was a story about technology, community, and rebellion. It showed that the balance of power in the financial world might be shifting. While hedge funds still hold immense power, they can no longer ignore the collective force of retail investors. The battle between David and Goliath might not have ended in a clear victory for David, but he definitely landed a solid punch and showed he could no longer be underestimated. The world of finance will never be quite the same. Thanks for watching. If you found this story as fascinating as I did, make sure to hit that like button and subscribe for more deep dives into the events that shape our world. See you in the next one.